Hello and welcome to the lecture for chapter 14. So in this chapter, I'm going to tackle it in a little bit different order than what the book shows. So I think it helps if we talk, well, first of all, this chapter covers long-term liabilities. So we've covered in chapter 11 short-term liabilities. So now we're looking at liabilities that come due beyond 12 months, beyond the upcoming 12 months. I'm going to tackle it in a little bit different order than what the book shows because I think it helps to start with loans and liabilities that you might be familiar with. So we're going to talk about installment notes first, and then in the second part of the lecture for this chapter, I'll talk about bonds payable, which some of you might not be familiar with because they're not used as much. So first I'll talk about financing a corporation. So when we start a corporation, we need to bring money into the company. We need to bring money in to buy assets, to invest in developing products, to invest in letting customers know about the products we have. All of those things take money up front before we start actually making sales and earning revenue. So there's a variety of ways that we can bring that money into the company. One could be short-term financing. So we could get short-term loans, which are generally seen as less risky by lenders, so they're more available for startups as an example. Might be financing from our creditors. We might, or rather our suppliers, they might be willing to grant us credit to start the company. So we covered that in chapter 11. The other way to bring money into the company is through selling shares of the company, through sharing ownership of the company, through issuing shares of stock in a corporation. We talked about that in chapter 13. And the final option is long-term debt, so borrowing money that's going to be paid further down the road, which is better from a company standpoint because they don't have to make immediate payments. Now there's trade-offs on each of these methods as an example. So in terms of equity, the trade-off there is the benefit is we don't have to pay that money back, right? If somebody invests money in our company and gets shares of ownership in return, that's money that we don't have to pay back, okay? So that's one benefit. The downside is we lose some control of the company. So remember, it's one vote per share for making decisions in the company. So to the extent that we give away shares or issue shares to people, they then get to participate in the decision making. So we don't have much control over the company. Long-term debt, on the other hand, we don't give up any control. The banks that loan us money for several years or whatever the term is on the loan don't have any say in how the company is run, so we maintain control over the company. The downside is we have to pay the money back, and that money is the first money that leaves the company. It is paid before your employees are paid for payroll, before your rent is paid, anything like that, and that money has to be paid back regardless of whether you're experiencing good times or bad times. So those are some of the trade-offs. So talking about installment notes, it's an alternative to the bond financing I'll talk about in the next part of the lecture. And it's usually issued by one single bank to finance the purchase of an asset. So I need to buy a computer system for my company. I can borrow the money from a bank to do that. I need to buy a fleet of delivery trucks. I can borrow money from a bank to do that, whatever the case is. So usually assets are pledged as collateral. So if I stop making payments, the bank can come and get my delivery trucks, and they can turn around and sell them to get funds to pay off that loan if they choose to. Installment notes that are secured by an asset are termed mortgage notes, although we usually use that term associated with buying land or buildings. The key thing with installment notes is payments are a consistent amount, or a constant amount rather. So any of you that have purchased a car and financed that car know that your monthly payments on the car are the same amount every month. Same thing with buying a house. You buy a house, your monthly mortgage payment is the same every month. So banks use a formula to determine what that payment is, and I've uploaded a spreadsheet called loan and amortization template that you can go ahead and play around with. I recommend that you download it and keep it on your computer because it's kind of a handy little tool to have, and it'll keep you from having to recreate it yourself down the road. So each of those constant payments that are made They contain a portion of the payment is associated with interest and a portion of the payment reduces the principal. So the portion that is associated with interest is based on the outstanding balance at that point on the loan, the remaining principal due. So as we work the principal down, the portion of each payment that goes towards interest will go down, and correspondingly the portion that relates to reducing principal will go up. So interest is calculated on the carrying amount, which is the principal balance. So let's take an example here. A company borrows $24,000 from a bank for a term of 5 years at 6% annual interest rate, and the bank uses a loan amortization table to determine that the annual payments should be $5,698. Now the book uses annual payments, which I've never come across in the real world, but it makes it a little bit easier to kind of get the concepts here. So in that case, when we borrow $24,000 for 5 years at 6%, the entry when we sign the loan or issue the installment note is we debit cash for $24,000 and credit note payable for $24,000. That's the initial entry. That records the receipt of cash and the creation of a liability. So in order to know how to record, how to journalize future payments, we need a loan amortization schedule. And this is similar to the template that I've uploaded for you on Canvas. So in this case here, I look at what the carrying amount is on January 1st. So on the beginning of this loan term, it's $24,000. So that $24,000 is outstanding the entire year. And you can see column B there, I'm making payments of $5,698 at the end of each year. So that first payment of $5,698, I mentioned part of it goes to interest and part of it goes to reducing principal. So I calculate the interest portion by taking 6% times what the carrying amount is. So 6% of $24,000 is $1,440. So of the $5,698, $1,440 relates to interest and the remainder reduces the note payable. So B minus C is $4,258. So that's the portion that reduces the principal. So after I've made that payment, the outstanding balance or carrying amount on the loan is $19,742. So then I go to the next year, that's my outstanding balance for the entire year. So I make my payment at the end of year 2 of $5,698. How much of that amount is associated with interest? Well, it's 6% of $19,742 or $1,185. So the amount that goes toward reducing the note goes up because less of that payment is going to interest. So it goes up to $4,513. My carrying amount goes to $15,229. And it carries on as you see there. At the end, the carrying amount when I make my last payment will be 0, okay? Sometimes we might have to fudge the interest expense based on rounding errors, that sort of thing, if we're not doing it to fractions of a penny, but you get the general gist of it. So to make my payment at the end of the first year there, I needed that amortization table to know. I know I'm going to credit cash for $5,698 because that's a payment I'm making to the bank. But if I didn't do a loan amortization table, I wouldn't know how much to debit interest expense and how much to debit the note payable for to reduce my liability. So I needed that amortization table in order to do this entry. So at the end of the first year, I debit interest expense for $1,440, debit notes payable for $4,258, and credit cash for $5,698 to record my first payment on the note. At the end of the next year, you can see I'm still crediting cash for $5,698, but the figures for interest expense and note payable have changed relative to what the loan amortization table shows. So that's the end of the first part of the lecture for Chapter 14, fairly brief one. The second part concerning bonds will be a little bit longer. So thanks for your attention, and I look forward to talking to you in Part 2 of the lecture for this chapter.